This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. This is a joy with Futures Up 20 because she has the courage to be in the market. You're never going to hear her say, go to cash. Alicia Levine joins us, BNY Mellon, right now. I want you to talk to the people. The boat's left the dock. They're not on the boat. How do you catch up into February?
So my line would be, never get out of the boat. And it's never too late to get in the boat. We had a sluggish start to the year, which is great, because we digested the move of the fourth quarter of 2023. And I think the market's telling you that we're normalizing, we have a more normalized rate situation, normalized growth situation. You got to be in. There's
quiet skew. There's a quiet within the internal dynamics. But the bottom line is it's a wall of money looking for a warm spot.
$6 trillion in money market funds, $6 trillion.
People are saying, oh, it would never go to equities. I'm like, are you kidding me? Yeah, it is. In what way will it go to equities?
It'll go to equities in several ways. The first is that there was a rush to money market because of the banking crisis in March. And you had folks who stayed there because they could sleep at night and it was the easiest place to be. We've been telling our clients all last year, get out of cash. It's set to underperform over the next 12 months. So we think a lot of that angst that happened about a year ago comes into equity markets, and it should be coming to the bond market as well. Because you're in a world where the Fed's not hiking, and it's either going to be the same or lower going forward, and that's very positive for risk assets, bonds, and equities, and you got to get in. I can't tell you how much of that $6 trillion is coming out, but a lot of that $6 trillion is the expression of angst over the last year of the rate environment.
So, Alicia, if I do want to stay in that boat, if you will, do I try to chase those big cap tech stocks that worked so well in 2023, or do I say, miss that boat, let me try to find some value in other sectors? What are some of the sectors you guys like?
So we have said I was here a month ago talking about our outlook, and I had this phrase, dance with the one that brought you.
Okay.
Meaning everybody wants to go to small cap or to go to international EM, and I say, you know what? That's probably a great trade and it'll work for 3 to 6 months, but ultimately if you're building wealth, I want to be where capital's treated best, and I want to be in the companies that throw off cash and don't need to borrow.
Paul, first grade insight of the week, Alicia Levine, BNY Mellon. I'm going to talk my book, folks. I can't say enough how the similarity to 23 is there. You got to find cash flow, quality cash flow, however you determine that. To me, it's a triple leveraged all cash fund. Maybe
of course.
Something more optimistic for you.
So, Alicia, on the fixed income business, our friends in fixed income actually made some returns last year after getting crushed in 2022. What do you think about this year? Where do I go in the fixed income space? I was shocked that last year the best performance was high yield.
That's right.
And
because we had no recession.
Yes, I guess that's the point. A lot of talk about recession, but no real recession.
So look, we like the belly of the curve. We're not saying go out to 10-year yet. We think that's just too long in duration. We like the 5 to 7 year range for govies right here. We do like investment grade here. That's sort of a sweet spot. We don't expect a recession, and with that, you're going to have, a more normalized year of returns in these asset classes.
So, I mean, it's interesting. We've seen a lot of issuance this year. I mean, companies are coming to the market. So when
markets are open.
Markets are open. So when one of the first calls is to you guys at Bank of New York Mellon. I mean, what are you looking for in some of the new issue market here for your credit teams?
So look, we're looking for cash flow. We're looking for sustainability of business. We'd like to see the debt that's been termed out and not floating rate. I just think that's just a better setup. But we like the quality businesses. And the fact that the market's open for issuance is really important because it's telling you investors know that the rate fear is over. Like it's done.
Let's go there. I mean, to me, the FT article over the weekend of the huge issuance coming into the market in the first 2-3 weeks of the year is valid. Does that sustain? To me, I look at these big tech companies and it's, on a Zvi Bodhi Boston University basis, they're like breaking the rule book. I mean, they have to do debt issuance. Am I wrong?
The large companies don't have to do debt issuance. They could just, to keep themselves floating around, but I don't think it's a necessity. I think it's just an expression that nobody wanted to issue debt last year. The markets were so tight, and get in while you can. And if you have the debt, then of course you're going to have M&A, and you're also going to have private equity deals finally getting monetized this year. So overall, it's a very good setup for markets in all parts of the capital markets. I mean, things can go wrong, yes. It's starting to smell like 1995. Oh. Right. It has that feel of, if the Fed's cutting and QT gets tapered, okay, you have the setup for liquidity in the market and you could have a nice bull run here. And I'll say this, the market's up 75% of the time since World War II.
Yep.
In the years where it's up double digits, the following year, 75% of the time is also up double digits.
I can't, yeah.
And so, just because we had a great year last year doesn't mean we have reversion to the mean this year.
So are you, I'm looking at the earnings for next year because I'm an old equity analyst and I do look at earnings. I think earnings matter. I see 12% earnings growth for 2024 over 23. Does that seem like a reasonable number to you?
We're lower. We're about 8 to 9% earnings growth. And we've done that from bottoms up analysis with our equity team. We think that's a fair place to be. I'd rather come in estimating that than come in at 12%, which I think is a heavy lift, right? It's a heavy lift. But look, in the end, large cap tech can pull it out. All they have to do is cut some headcount, and all of a sudden your earnings in the S&P is up 10 to 11%. So they can really affect the metrics on this. The structure of the markets and the power of the top 10 companies is really without precedent, and how they can affect the entire index.
Right. How'd the hedge funds do this year? I mean, I'm seeing bar charts that they had their most profitable year and all that. I don't buy it. How long short do? Shorting here is brutal.
It's brutal.
It's brutal.
It was brutal last year because even, you probably had a great year on the short side the first 10 months of the year, and then you got taken out the last 2 months, and that's your year. And everybody's judged every 12 months, and you got to repeat it January 1. So I think it was a tough year on the short side.
Yeah, I mean, they're going, like 20 companies guessed right on macro or whatever. Great, but everybody else got hammered.
So when you talk to your clients here, 2024, what did they say? Did they say, we kind of took too much performance into fourth quarter last year, and so I need to be a little bit cautious in 24? Are you trying to talk them off that sideline, maybe?
So that's always a question.
Okay.
And then we'll say that market timing is impossible.
Right.
If we're fundamentally positive, you should get in. That's the first question. The second one really is always about what's going on with our political situation and the election. And a lot of our clients have angst about that.
Okay, the clients do, but are you, just quickly here, you really think politics plays into what I should be doing on a 3 and 5 year investment call?
No.
Thank you.
And that's my message.
You're dismissed.
Don't let your politics get in the way of investing.
Alicia Levine, thank you so much with BNY Mellon. Hope to see a lot of her in 2024.
All right, let's check in with our good friend Scott Croner. He's over there at Citi, formerly Smith Barney, and I don't know where else he was, but he's been around doing this equities thing for a long time. He's out in San Francisco. Hey, Scott, thanks so much for joining us here. Boy, what a end to 2023, and I kind of felt like, boy, as we spoke to a lot of investors, that maybe that really rip-roaring ending to 2023, maybe that took some of the performance away from 2024. How are you guys thinking about this early part of the year?
So that's been our view. So, we thought that, to your point, that the rally into the end of the year was early stages of what we think will be a bigger broadening theme for 2024, away from that mega cap growth leadership that looked to be unfolding. And our view had been that the Q4 earnings reporting period would be your premise for that, whereby you get companies beating Q4 expectations, but probably being a little bit more cautionary on their full 23 Q4 expectations, but more cautionary on 24 outlooks. Still early to judge that, but what's happened in the meantime is that you've gotten, I think, some more generative AI support for the tech space, which has kicked the NASDAQ 100 into overdrive again.
Wow. Yeah, exactly right. And I'm wondering, Scott, what are your tech guys saying over at Citi? I mean, how bullish are they on this AI thing? Is this really incremental? Can I really use this as an investment theme in 2024?
Well, and to your point, it's a really good question. The way we're arguing it's consistent with what our analysts are saying, is that it becomes more idiosyncratic. It's not a big seven or a magnificent seven this year as it was last year. I think you're going to see different components of that mega cap growth cohort that's going to have a fundamental tailwind more directly or perhaps not. We've been arguing that software should show that. Semiconductors are beginning to show more signs of that, but that's not true for others of the big seven that might be held up in, let's say, the autos component of the market. So we think the point here is that that the 24 setup for many of these companies is one where you're getting the news flow. You're going to need to see it translate into fundamentals to keep these stocks working.
What's interesting, and Alicia Levine brought this up with BNY Mellon, of an analog back to 1995. And it's got some of us of a certain vintage. I mean, an old guy like you has seen it. Paul's too young to have seen it. But the answer is we partition into quarters. We partition into annual returns. And the reality is, it's like longitude, latitude on a map. They're just lines. They're just calendar dates. And the answer is last year can extend into this year, can it?
Well, I mean, yes, to that point, if you look at the 2-year return on the S&P, it's not very meaningful. And that's true for the NASDAQ as well. So when you go back and look at the way we've come out of the pandemic lockdowns, we had the big risk-on rally in 21, 22, big valuation reset as we were contending with a hawkish Fed. And then, 23 was a combination of generative AI promise kicking in, as well as more evidence that you're getting at a peaking Fed. Now we're about to shift at some point this year into a more dovish Fed. And for many investors, this follow the Fed mantra is an important point. So I think it all kind of sets up pretty well constructively as we look into full year 24, perhaps beyond.
I mean, Lisa, to me, it's just really, really crucial that people understand that we're not slaves to the calendar. And I look, Lisa, at the shock of November and December last year, up. We continue up. And everybody's sitting on the sidelines in cash. I mean, the Mateo families, they're triple leveraged on cash. Charter members. When are you going to move out of cash, Lisa?
Never. Are you kidding me? No, keeping it under the mattress. That's it.
I mean, the whole keep under the mattress thing, Paul, is a scar of all this.
I know, and I think
pandemic.
It's one of the the bullish calls out there for a lot of folks. So Scott, I know you guys. Speaking of cash, I know you guys at Citi have been on the forefront of kind of ETF and ETF research here, and just in the last few weeks, we've had that Bitcoin ETF. When you're talking to your clients out there, where are we now in just thinking about ETFs as a real option? I mean, I joked to Tom that we used to spend half my life up in Boston visiting the mutual funds up there. I'm not sure we do that anymore. Where are you guys with ETFs?
Well, I mean, we think there's an ongoing brave new world that keeps unfolding via ETFs, and there's a sort of a new next big thing that keeps kicking in. Gone are the days where you're just simply passively, replicating underlying indexes, and in are the days where almost all the new launches now have an active spin to them. So and you're seeing many of the major mutual fund complexes move into ETFs. So, we think that the ETF wrapper continues to expand, continues to reflect the underlying entrepreneurial spirits that the markets are about. And, we think that that's kicking into gear. When you look at the flow dynamic, it's been mostly out of mutual funds for the past year and mostly to the benefit of ETFs. So, we think this is a big deal, but we think also what you have to keep in mind is that increasingly, these are the tools that are being used for the model portfolios that more and more financial advisors are investing client assets on.
Huge deal.
So that become a big deal.
Massive write-up. I'm going to give credit to the FT. I can't remember exactly. BlackRock with a massive restructuring going on there. Mr. Fink driving just what you heard from Mr. Chronert. And it just, I wonder, Paul, is it death of traditional mutual funds?
I tell you what,
people want this. People, and Eric Balchunas, we tried to get Balchunas in the 7 o'clock hour.
Oh, no way.
We couldn't yet. It's
busy.
just too early.
Yeah, he's too busy.
He's coming up late.
But I mean, you even see mutual funds, Tom, converting into ETFs. It's just really an extraordinary change. I know the research folks at Citi have been all over this. So, Scott, as we step back here, kind of what are some of the sectors that you guys and your team are focusing on here for 2024?
Okay, so we're playing this broadening theme. The argument has been, most of last year's returns was a function of this mega cap growth cohort. And the view is very simple. You can't continue to premise a broader, higher market on just that. You need a broadening effect. Aligned with this gradual pivot in the Fed and what we think is happening with fundamentals from an earnings growth perspective, our view pretty simply has been that the broadening effect has to be a key driver of future upside. We began to see that in November and December as you saw 10-year nominals come off of that 5% level. We're taking a little bit of a step back to start this year, but we think that's digesting that move. So from a sector perspective, we're saying hold growth. We're overweight tech and comfortably there, but we're suggesting other sectors such as industrials, which has been a longstanding favorite of ours. And recently we went overweight financials as ways of expressing this.
30 seconds. Scott Croner, what do you do with healthcare? It was supposed to be the darling last year. It wasn't. It has an ugly beginning of the year off hospital, non-earnings, non-cash flows. What do you do with healthcare?
You own it. We upgraded from an underweight, which we had all last year, to a market weight recently. So the fundamentals aren't perfectly there yet to get us really excited. But I got to tell you, when you look at the earnings growth setup going into 24, healthcare is set up to have one of the more aggressive mean reversions to the positive this year. And so we want to have healthcare exposure, no question about it.
Scott Croner, thank you so much. With Citigroup. Jennifer Lee joins us. She's with BMO Capital Markets, far more doing a holistic view on economics as well. Jennifer, what is your Q4 call? Mike McKee was talking two-ish. Can we do better than two-ish?
Ooh, I'm sorry. First of all, good morning and thanks for having me on. Actually, we're a little bit lower. We're at 1.5-ish for GDP growth, which is actually a little bit of an upgrade from what we had previously, thanks to that stronger than expected retail sales number. But overall, we're still seeing growth, which is pretty incredible, given that we've had over 500 basis points of rate hikes over the past couple of years. So, hey, this is a good news story, I think.
In the formula, what's the distinction between, say, 2.2, 2.3% and your 1.5% call? Is it investment? Is it a net export dynamic? What's the variable that gets you to be more quiet?
I think it's going to be on the trade side as well, just like a little bit of a hit from net exports overall. Business investments has been a little bit lower, but I mean, it's going to be all about the consumer. And I think that's obviously the biggest part of the U.S. economy. So the U.S. Consumer has been driving all this momentum forward. Now, how much they can continue doing that remains to be seen. But I mean, I feel like every quarter this year, we have been bumping up our forecasts. It's like, upgrade to the growth forecast again, which again, it's not a bad thing to do at all.
And Paul, this is critical. Jennifer nails it in that it's a net export mystery. That's obviously a China mystery.
Yeah, sure.
Maybe a Germany flat on her back mystery. I'll let you decide if it's an EV vehicle disaster mystery. I don't know, but she's dead on that we ignore NX on the back end of the equation.
I think so. And I think, Jennifer, one of the things here that I think just kind of surprises a lot of observers, including myself, is the strength of the U.S. consumer here. Give us your sense of kind of where the consumer is these days and kind of what are your expectations here for 2024?
So as long as the job market, job market is actually, it's all going to be going down to the job market and job and labor demand. Job growth has certainly cooled from, do you remember that 1 month with over 500,000 jobs, which is obviously not sustainable. So we're going down to a slower pace of job growth, which is okay. We've got the jobless rate still picking up at 3.7%, I think is the last figure that we've had. So we do have it inching higher. But overall, as long as, broader demand for labor remains strong, consumers or workers continue to receive a decent wage, to maintain their standards of living. Putting some aside for a rainy day, as I always say, is not a bad thing. That is what keeps the consumer moving forward. Of course, whether or not they're going to be resisting some of these price hikes is another story again. But as long as they have something in the bank, something tucked away for a rainy day, I think it keeps them in a very good position.
All right. Given that, I mean, that's a solid backdrop for the U.S. economy. Not the same for China. And boy, if we were just rewind a year ago, everybody's 2023 outlook was kind of predicated upon a strong rebound in China, and that did not take place. What's your read of what's going on there now and kind of how we should think about China over the next 12, 18 months?
So a year ago, this is when they were first coming out of that lockdown. So it looked like they were like the savior to the world with that really strong, and I can't remember what the number was, Q1 GDP growth figure. And of course, everything fizzled even before the first quarter came to an end. But it all boils down to, a very weak property market. It's no longer, we're not seeing that same kind of housing demand. Everything was overbuilt. So that the property market itself accounts for the biggest part of for China's consumers or households' wealth. So when you see your property losing value quickly, it hurts confidence. It hits Chinese consumer spending, and that, of course, will hit businesses' ability to raise prices. So you're seeing that deflation there. So that's what the hardest part. That's what they're trying to overcome. They also have major labor issues. They're not only losing in numbers, but in age as well, rising age. Everyone's getting older. We saw last week about how the birth rate was at the lowest ever. The death rate rose to its highest since 1974. Those aren't good stats, and that's actually the population side is very disturbing.
And this is really good analysis. Jennifer Lee, then, what is your run rate? Almost like potential GDP of China? Totally unfair question. Nobody has a clue. But are you going to frame out potential GDP that used to be 7, 8, 9% is now below 5%?
So we've got it's a great question. What we have for the next couple of years, like this year and next year, at about roughly 4.5%. Whatever their growth target is, right now it's around 5%, that they met it last year. But, it looks like whatever the target is going to be, if they're going to have a target this year, is probably going to be below that. Like I said, around 4.5%. So this is why they're trying to work on their up and coming. I think they're calling it the new three. I read that somewhere. You've got EVs, of course, AI as well, and the renewable energy sources. That's what they're trying to build up. Small part of the overall Chinese economy, but that's what they're trying to create and to rely more on. And plus, it's all also very much less labor intensive than what their strong sectors were in the past. So this is what they're trying to work on, and then at some point it's going to be a bigger driver, I think, of the overall Chinese economy.
All right, so if China is sub 5% growth, and we've got economic weakness in Europe, particularly in Germany, as Tom was mentioning here, it just makes the U.S. look that much more, unusually strong, I guess. How do you think about the U.S. relative to other parts of the world? How unusual is it for the U.S. to be such an outlier, if you will?
I don't know if it'd be fully 100% unusual, but I mean, right now it's certainly looking like it is the one big driver and the one big bright light in this whole in the world. I mean, everyone else is still growing, but it's just not as strong as the U.S. dollar. And this is why, and I'm just going to switch this a little bit to on the currency front. This is when we're trying to look at our currencies. We've been calling for a weaker U.S. dollar for some time now, just as the Fed starts to cut rates. But I think that as long it's all about perception, global perception of the U.S. economy. If the U.S. economy is slowing but still perceived to be a lot stronger than what we're seeing in Germany, for example, and in China, it's going to still keep some strength behind the U.S. dollar. It won't weaken as much as as one would assume in a period of Fed rate cuts, which we're looking forward to start in the second half of this year.
Jennifer Lee, thank you so much. In your free time at the Bank of Montreal, would you fix the Montreal Canadiens? This is an important interview because there's a lot of people out there saying move away from the Magnificent Seven, and one of the places to diversify into is mid caps and small caps. She's truly expertise on this. With RBC Markets, Lori Calvasina owns the High Ground as well. It's been a pretty good couple months for mid caps and small caps, Lori, hasn't it?
It has. We've gone from when I go into meetings, my salespeople sort of whispering, "Hey, Lori, this is a large cap person. Don't talk about small caps," to literally every meeting in the first, 5-10 minutes. Doesn't matter if you're large cap, small cap, growth, value, hedge fund, long only. Everyone wants to talk about them. So they got a little crowded.
Yeah, are there Magnificent Seven in mid caps, or dare I say small caps as well? Is like a focused overweight?
It's a great question. I would say quality is the thing that you always hear day in, day out, year in, year out, that small cap PMs are never going to really gravitate away from. And so you do tend to see certain names at the top of the Russell 2000 get concentrated. That's something, though, we've been seeing that for a decade or at least. And, we don't see it nearly to the same extent. Even the crowded stocks in small cap, there's still, a lot of diversification among what managers own relative to what you see in the big cap space.
See, but Lori, I just don't buy the small cap thing. I've just been burned so many times. Investors have been burned so many times over the last 20 years here. How do you think about the small to mid cap universe these days?
So it is getting jerked around a lot more by ETFs and passive money than it has in the past. And so that's why I think that we are seeing very wild swings. And, we do see the hedge fund community in particular try to make trades. You often will see it when there's, sort of a domestic focus trade that they want to do. Trump's tax cuts back in 2016 caught a lot of, small cap eyeballs. But I think what really did it this last time around was Fed cuts. And we'd been telling people all last year, when people got ready to put on their Fed rate cut playbooks, small caps were one of the first places they were going to go. They were cheap, they were underowned, and they typically outperform when the Fed starts to ease. And so sure enough, when 10-year Treasury yields peaked back in October, we saw really sentiment change. People were had less of a desire to sort of cling to the pristine balance sheets and move back into small caps. And by the way, a lot of small cap companies had been out telling investors, hey, our balance sheets are not nearly as bad as feared. So it really just set up for a really awesome trade. Unfortunately, it just got consensus at the end of the year. That doesn't mean there's not still opportunity there, but I think you need something more than an interest rate trade to keep it going.
So how about earnings? I'm an old equity analyst. Earnings still matter to me. We still have the S&P looking about, 11, 12% earnings growth in 2024. How do you feel about that? What's your comfort level?
So when we're looking at the large cap space specifically, we're looking for something more like 4 to 5% earnings growth this year. And that's not to say that I think the year is going to be a disaster. We still have 5150 target on the S&P. We think multiples can expand a little bit more. That's a whole separate discussion. But I do think when you look at that 11% that's embedded in the market for earnings growth in the S&P, you look across every sector, pretty much, every single one, you see pretty robust margin expansion baked into consensus forecasts. And as I was talking to non-US investors in particular coming into the new year, there was a lot of skepticism that those lofty profit margin expansion expectations were going to come to fruition. And I tell you, I share that concern. I'm modeling basically flat margins versus 2022 in our model.
What do they do on a nominal GDP basis? Do they outperform, or is the big companies so growthy they actually get a better revenue pop?
So, it's interesting. I haven't looked at the revenues too closely. I do think that those kind of bigger cap companies, they have much bigger cash piles. So I'm guessing that there's, sort of more buffer from that in terms of interest income. They've also just had much cleaner balance sheets in general, so there's less interest expense as well. But I do think, the concept of moats is something that we always hear quite a lot about, and I think that is a very real consideration. But I'll tell you, our chart of the week this week in our weekly was actually looking at the forecasts for earnings growth in the top 7 versus the rest of the S&P, and we pulled this data from Bloomberg. It's on the terminal. This were not my numbers. And it was remarkable to me that gap between the top 7 and the rest of the S&P, it's still there, but it's shrinking over the next few years. And I'm really excited to take this chart out on the road and really understand how investors are going to react to that kind of shrinking earnings buffer. I'm not quite sure what people are going to make of it. It's going to be interesting to see if people view it as, hey, it's a tailwind that's dissipating, or it's still stronger, we just don't care.
So when you do go out on the road, Lauren, and you talk to your institutional investor clients here, are you getting the sense that maybe they felt like they missed out on that big move at the end of the year, and so they're playing catch up here, or are they trying to find some value? Where are they looking these days?
So, I think that if you look at the top 7 versus the rest of the market, I think there were 2 camps last year, really around mid-year. There were people who were big believers in AI, big believers in these companies, and nothing you could say was going to change their minds. And then there was sort of the rest of the market who hadn't gone as all in, and they were skeptics, and that skepticism hasn't really changed. So I think that latter camp has really been waiting in the wings for the market rotation to happen. And so I think they've actually been pretty excited. I mean, they're sort of in my camp, a lot of people that, maybe we ran a little too far in 4Q and we've got to give some of it back before we can move forward. That doesn't seem to instill panic in this camp. They just think that it may take a little bit more time. And one of the things I've told them is, if you look when GDP is above or below average, when it's below average, large cap and growth tend to outperform. And that's been the environment people have thought we were in for a long time. But GDP forecasts are moving up. So if we start to see GDP move above average, and average is about 2.5%, that could really unleash a second act of small cap and value outperformance, or broadening, is probably the catch-all between the two.
Lori, can you explain to our audience what it means to live on the lawn at the University of Virginia?
It means that your classmates see you at your bathrobe at random times of day. It's basically, when I was there, it was the university's highest honor. I want to say there were maybe 50 some odd of us who got chosen every year because of extracurriculars, service to the university, and academics to live there. And it was a committee of peers that would select you. And it was really just your overall contribution to the university that you got recognized for. And I was privileged enough to live there in my 4th year. One of the best experiences of my life. I met some amazing people.
Absolutely amazing. Absolutely. Thanks for asking that. And Paul, it's great. As I was giving a speech at Darden, and you can have to walk over there. It's like a movie set.
Yeah, I know.
And I walked by Lori's dorm, her hall. It's these little itty bitty doors right in the grass. There's 2 cases of Coors Light out front.
Right front. Yeah, that's exactly.
Lori was killing it. Lori Calvasina of the University of Virginia, also with a nodding acquaintance with RBC. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.